We do appreciate it. Carol, you love talking real estate.
I do. It's like one of my favorite things to read on the weekend, like looking at property values, comparisons, and all that good stuff.
I think there's like a whole, like Zillow fantasy land that people just like go and look at.
Have you ever been in a car? I've been in a car with people and they've got like their Zillow app open and like, oh, that car and that car, that house. That's what
Is
it's
that
worth.
Me when we drive from LAX somewhere?
You did
Yeah,
that.
that was me.
But you're not alone though. There's other folks that have done it.
So our Bloomberg Intelligence team out with some research today about the outlook for North America apartment REITs next year. They argue that the rent growth will be softer. U.S. apartment REITs entering 2026 with less pricing power. They also say that REITs are eager to grow, though through building or acquisitions, given, quote, pristine balance sheets and the prospect of falling rates. For more, I want to bring in Jeffrey Langbaum, senior REITs and commercial real estate analyst for Bloomberg Intelligence. Also joining us, David Auerbach, chief investment officer of Hoya Capital Real Estate. Jeff joins us here in the Bloomberg Interactive Brokers studio. David in our Bloomberg Dallas bureau. Hoya Capital is the advisor to the Hoya Capital Housing ETF, the ticker HOMZ. It benchmarks the U.S. residential real estate industry. The Hoya Capital High Dividend Yield ETF is ticker RIET. Jeff, David, welcome to both of you. David, we're going to get to you in just a second because you have the Homes ETF. I think is really interesting because you have Lowe's, Home Depot, Anywhere Real Estate, Wayfair. So it's kind of a wide variety of everything building and real estate. But Jeff, I want to bring you in and just get a broad look at REITs right now, because not just this year, but over the last few years, a higher rate environment, it's been kind of brutal. It's not monolithic. And Carol was joking about data centers and the way that data centers have been exciting to people. But broadly, the industry's really struggled.
And I think data centers and AI is one of the reasons for that, because if you think about it, someone put this to me once, and it's been in my head since. Any long bet on real estate is by default short AI, and you can't afford to be short AI
because it would be you're essentially saying are you talking commercial real estate, just any real estate,
REITs. If you're an institutional investor and you're investing in REITs, by definition those dollars are not chasing AI.
Oh, I see.
And over the past couple of years, that's been the wrong bet.
Right, investors have a certain pool of and you want to be on the right side of the bet.
Correct. And so that has that, and obviously rates have been elevated, and that just doesn't set up well for REITs. And that's led to 3 years of significant underperformance that theoretically creates an entry point, perhaps, especially if your view going forward is that rates are going to fall from here. So the fundamentals, we can go sector by sector, but overall not bad. Sets up for some, reasonable growth. And if rates cooperate, theoretically, could be a much different story, especially if AI is a bubble about to pop, and then maybe that capital rotates back in.
I know, but depending on the day it is, and depending on the day it's not. Hey, David, come on in on this. I mean, how do you see it in terms of the environment and what it means for REITs generally? And I know it's really bad to kind of lop everything into one bucket, because data center versus hospitality versus residential versus commercial versus office and all that good stuff. They're all different beasts, but how do you see it generally? And then dig a little bit deeper, if you will.
Sure. Thanks for having me. Frankly, there's a lot to unpack here. And frankly, a lot of the comments that Jeff said echo what your previous guest just said. When you look at the world of REITs, it's not a 1 month trade or a 3 month trade. When I chat with advisors and investors, I tell them they have to look at the REITs with the 10 to 25 year glasses. If you want a short-term lease, go out and buy yourself a hotel REIT with a 1 night lease. But in the world of apartments, it's a minimum of a 1 year lease. With office and retail and some of these other sectors, it's usually a 5 to 10 year lease. And then there's companies out there like Safehold, which focus on ground leases, which could be a 99-year lease term. So when you think about the power of REITs, we really look at them as dividend income compounding machines that over the course of the long term, you would hope that dividends continue to grow, and that compounding effect would, grow the income in the portfolio. I think looking at what we're talking about here, as Jeff had mentioned, REITs have underperformed the S&P by about 70% going back to the Fed rate hiking cycle starting in March of 2022. Over that time period, we saw 36 different REITs go away or explore mergers or opportunities, while only 10 new REITs came to market. Now, fast forward to the past quarter alone, we've seen 10 different REITs that are in play, exploring options, merging, figuring out the next ways to unlock shareholder value. So I do think that we are seeing signs, whether it's the debt markets that are wide open for REITs, the preferred market, seeing a couple of REITs issue preferred stocks, forward equity arrangements, et cetera. We've seen different triggers that have been executed that are showing that I think the thaw in commercial real estate sentiment is starting to improve.
Yeah, David, we have a chart up right now that just shows in the last 2 years, the S&P 500 is up 48%. The Hoya Capital housing ETF up 23% roughly. The Hoya Capital high dividend yield ETF down about 5.5%.
I mean, that's tough to compete against, right? When folks are saying, look, if I just buy the market, I buy the broader index, I have outperformance.
Yeah, and I think it's important to peel back the layers of the onion. I mean, we could talk about homes versus REIT. There's two completely different stories there. But I think, as we've mentioned, this AI tech bubble overweighs or outweighs the market. Same thing with crypto or some of these prediction markets or single stock ETFs, some of these other plays in our market. You know, I like to say REITs are boring. And boring is good. Slow and steady wins the race. You know, when I go to advisor conferences, I joke with my partner that those advisors aren't seeking out the REIT guy. Who wants to talk to the REIT guy? They want to go talk to the guy who's got the new fund that's in vogue, that's gaining all the headlines or all the traction. And so for us, slow and steady wins the race. And thus, you know, you look at some of these signs that are out there, whether it's New York office REITs starting to see improvement, leases are going up. Some of the retail guys, due to lack of new development over the past few years, seeing double-digit releasing spreads. A frequent guest on your network, Stephen Yaloff from Tanger, talking about the experiential offerings, these different concepts that a lot of retailers and office providers are putting in amenities in place to try to lure people to come to the property. What can we put in place to make sure that somebody comes and hangs out with us for a few hours?
Ask Jamie Dimon about the new headquarters of JP Morgan and how he gets people to come to the office, because that seems to be setting the standard right now, Carol.
People are back in the office. Yeah. That's not the story anymore.
But not 5 days a week.
Not 5 days a week.
And that can be an issue.
But not sufficient at this point to start pulling office demand lower.
Okay.
Right. I think that ship has sailed. Now, whether AI adds another element of potential workforce disruption.
That's what I thought you were saying about the AI trade earlier, is that, you know, because of supposed productivity gains as a result of AI, Jeff, we wouldn't need as many people in the office because not as many people would be working.
That's the next potential concern. Not seeing it yet, but that's the next potential concern for office demand. But the thing is, with office, you know, and not necessarily to dive too deep into one specific sector, but, you know, with office, it's kind of bifurcated now, right? The better properties are full and in such high demand that there's a pricing war for that space.
Yeah, your Class A properties are doing just fine.
And the rest of it needs to become something else, right? I mean, it's what happened in malls 10, 15 years ago, right? The bottom third is gone, and the top is, you know, performing pretty well. You know, if productivity gains do remove a little bit of demand on the margin, that's not going to impact the overall demand for these high quality assets, right? We're starting to see, you know, new office developments here in Manhattan come out of the ground, right? There's a need for new office space here. Because there's not enough of that high-end stuff.
What about, you know, and David, come on back in terms of affordable housing, which I've been doing this a long time. We've all been doing this a long time, and we've been talking about affordable housing for decades. And it certainly is coming up in political elections. We certainly are talking about it here in New York City. What is the answer to getting affordable housing in the places that you need it?
Well, thanks to Tim for setting it up, talking about homes, because this is our core thesis. There is no affordable housing. We need to see several levers pulled to make housing affordable again. Number one, lower mortgage rates. That's the easy trigger. Number two, more though, is an affordable housing product. As I like to joke, instead of your favorite home builders delivering a premium product, we need to see those home builders issue what we call a light product. So instead of an $800,000 new build, we see a $300,000 to $400,000 new build product. That being said, really the beneficiaries of this housing crisis are the REITs, meaning the residential REITs, the apartment REITs, the single family rental players like Invitation Homes or AMH, but also the manufactured housing REITs like Equity Lifestyle Properties, Sun Communities, or UMH. I think with those guys that are offering the more affordable, easier to obtain product, then we might be able to start tapping into some of this supply-demand imbalance. And I think you notice that in some of these rent-to-own type properties or some of these platforms that are out there. But we still feel that we are a long ways off from solving this housing crisis.
He just hit on it. It's the supply-demand imbalance. There's just not enough new construction of single-family, multifamily, anything.
But interestingly enough, David didn't say zoning, which is something that we talk about a lot in New York City, and I think that's an issue around the country too. It's just that there are areas that are not necessarily zoned for building homes.
But it's not just zoning. That's obviously part of it. It's the economic return to the developer.
That's
right?
what I was thinking.
Is
They're
the
not going to
price
make as much money
or the rent sufficient to get a return? And obviously cost of capital is a big part of that. Rates are, they're theoretically going to come down, but they haven't really started coming down yet. So you need that to turn to really trigger shovels in the ground.
Hey, David, before we let you go, is there a light housing product that you've seen? Is there a way to build half the price that they build now?
I mean, you can buy a manufactured house on Amazon these days. So I think you are starting to see some of these platforms try to develop a more affordable product. Carol was talking about Zillow before and how people sit there and scroll Zillow. And I think that's almost like a doom scrolling type of thing. The reason why I mention this, my wife and I like to joke about our starter house that we bought when we got married. And that house that we bought back in 2006, according to Zillow, is worth 3x today here in Dallas. And we like to look back and joke, is that house actually worth what it says it's worth? And they're like, no, of course it's not. Yeah. And so if that affordable house is being pushed further and further out to folks that are in their 40s or 50s, what are we supposed to do to tackle into that problem?
No, yeah. Hey, listen, this conversation to be continued. Jeff Langbaum of our Bloomberg Intelligence team and David Auerbach, Chief Investment Officer of Hoya Capital Real Estate. This is Bloomberg.